Determining how patronage income should be distributed is an important process for any cooperative. The senior leadership team will work with accounting and financial experts to develop a plan to present to the board of directors. The board will then discuss with senior leaders how to best distribute patronage income, and ultimately, the board will vote on how the cooperative's patronage income will be distributed. While the details of this process can be very complex, there are some key decisions that help explain this process. In this video, we will use a straightforward flowchart to explain the patronage income distribution process.
At the start of the flowchart is total net income. This is the income or profits to be distributed either to the cooperative or to the member. From here, the flowchart progresses through 4 distinct columns that each address a specific question regarding the distribution of a cooperative's income. First is, who conducted the business? Second, whose name is on the distribution? Next, who pays the tax? And finally, who receives or holds the funds? In the first column, we examine who conducted the business with the cooperative. Patronage-based business or patronage income is conducted with cooperative members. As we have discussed in previous videos, this is the income that the board of directors can elect to distribute back to members. Non-patronage income is next. Non-patronage means the cooperative conducted business with someone or an entity that is not a member of the cooperative. Given this is non-member business, the vast majority of co-ops do not distribute these profits back to the members.
It is also important to note here that in order for a cooperative to keep its legal status, more than 50% of the business must be with members. In other words, more than 50% of total income must be from patronage-based business.
After identifying who conducted the business, we can move on to whose name is on the distribution. If patronage income is distributed back to members, then it is said to be allocated. Members' names are on the distribution. Patronage income can also be distributed to the cooperative or unallocated, which indicates the cooperative's name is on the distribution. In the case of non-patronage income, it is distributed back to the cooperative or unallocated. Once the income is distributed to either the member or the cooperative, the next set of decisions is to identify who pays the tax. In the case of an allocated patronage income distribution, either the member will pay the tax or the co-op will. Who pays the tax depends on if the distribution is qualified or non-qualified. If it is qualified, the member is responsible for all taxes. If it is non-qualified, the cooperative is responsible for paying the tax initially. All other distributions, such as unallocated patronage and unallocated non-patronage, are not able to be distributed back to the member, so they are not qualified and the cooperative is responsible for paying the tax.
For more on qualified and non-qualified distributions, please refer to our separate video on this topic. Finally, we need to identify who receives or holds the funds. In the case of a qualified, allocated, patronage income distribution, the co-op member could receive a portion of the distribution as a cash patronage refund or as a retained patronage refund. Cash patronage is just cash paid to the member. Retained patronage refund is allocated equity, which is held by the cooperative and will be redeemed or paid back in the future. The member is responsible for paying all of the tax on a qualified distribution. Because of this, the law requires that a member receive at least 20% of this distribution in cash. Typically, cooperatives pay a higher percentage of cash because the member's tax obligation is greater than 20%.
Let's go through an example. Assume a co-op distributed $1,000 of patronage to a member. All of this distribution is allocated and is qualified. The board of directors declares 40% as cash and retains the remaining 60%. That means the member would receive $400 in cash and the co-op would hold $600 as retained patronage or equity with the member's name on it. In the case of a non-qualified allocated patronage income distribution, the cooperative holds all of the distribution as member equity. No cash is paid to the member because the cooperative must pay all of the tax on non-qualified distributions. When this non-qualified member equity is paid back in the future, then the member must pay taxes on these funds and the cooperative receives a tax credit. This transaction occurs because co-ops are single taxation entities, so all of the profits must be taxed only one time.
When patronage income or non-patronage income is distributed on an unallocated basis, these funds go into the cooperative's retained earnings. Retained earnings are equity that a cooperative can use to help fund capital expenditures and other projects. In this video, we took a high-level view of the process to determine patronage income decisions. Certainly, there's a lot more planning and discussion that goes into this process, but having a firm understanding of these terms provides the foundation for being able to better understand patronage, which is a unique benefit of cooperatives.